Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you a strategy of the day update here for corn and soybeans. We're going to be looking at old crop and, new crop corn and soybeans here, and then as well as one spread I wanted to leave us with, which is a intra-marketing year spread there between the December and the July contract for corn. But remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. But if you are interested in hearing more of what I have to offer in terms of trade recommendations or working with a broker that can offer you this type of level of service and analysis, my number's there on the screen, 312-277-0110. Find me on Twitter, Facebook, or shoot me an email, dhussey@zaner.com. You can also leave your likes and your comments in the section for this video. Love hearing from you guys. So all that being said, got a daily chart up here of December 22 corn. We've looked at it a lot in the past. We have been basically been in an overbought kind of condition here since July in this pretty nice channeling uptrend. We're holding that 18-day moving average above that as support. We held above that 100-day moving average here yesterday at 670 after breaking back above the support. The 55-day and 200-day moving averages are now heading, both turning back higher. We are overbought, and that daily stochastic RSI at 85 over. And really, corn has continued to channel in a, like I mentioned there, up into resistance here. We take a look at the larger daily charts in that Thursday webinar. That's Thursday at 2 p.m. Central. The sign-up links are available in the comment section and the information section of this video, and that strategy of the week webinar where we go in a little bit more detail of these charts and what's going on. But the 4-hour chart for December corn here, an open gap below us at 628, down at 584 as well. We've been channeling higher and in the upper 50% of this channel, in fact, in the last several weeks, pushing up into overbought territory and back up into a test of this old supportive area from $7 down through 684. It was the range that we were holding April through May that we eventually broke down below through into July. We're coming up to test that old support now as resistance. We have also tested into the 50% retracement of the entire decline and tagged that 61.8 line now up around the 690 area. We failed today at $7, that's a big psychological level for corn, but it's also a downward sloping trend line from the 677 highs through that high of June, came through the charts here right about 7, so kind of failed to get there. We're also failing to get all the way up towards that 730 gap, but that could be, an upside target here if corn continues higher. Cleaning up the chart and, trading towards that gap fill could be one method that this chart is looking to play out with. All that being said, support now on this chart, we'll probably look for one trend line from off through the lows here down around 670. Another one comes down to channel support around 650. And that's where, to me, the next in the series pullback could be, because now that we've broken through that 50% retracement for corn, I'm going to make it, leave that level up there and make it purple. There's a reason I'm doing that, and it's when we look at soybeans in a minute, that'll express why, because there's the chance that we head back down, we break a 50% long on the other direction and trade a 61.8 line, from the lows to the highs. And if we do, then we could be in a larger range, and we'll talk more about that if it ever happens. But it's something we need to plan for and trade and keep looking for, and that's why I leave my chart the way I do. All right, so with all that being said, corn off of the lows, we did have a bit of a long trend here with a 50% retracement from the 560 area all the way up to this high here. You can make an argument we traded 50% from that 636 high too, but that high that we made after kind of reset the market in a pullback that we held down around $6, that 602.25, 50% line never really traded but was front run. And the market traded up to and through its upside target. So now from the high to the new high, we have a supportive area on corn we need to be aware of around 670. Also happens where this upward sloping trend line against the lows comes into play. But the next in the series long is from its entry low to its now new highs here, but this is a bit of a breakout long, and that supportive area comes in with a fib here at 650. Also happens to be right around the lows of the month. Not one I would necessarily look to take, but we'll of course come back to that fib if we get down to it. The one I'm more interested in is around 670, and of course, if we go below 640 or 660 here, this particularly 664 in the near term, we threaten that trend line, and then could be breaking down. Open gap around 630 could become an immediate downward target. And because we broke above that 61.8 line of the entire decline, now the rally from the 561.75 low to the new high that broke the 61.8 line up here around 699.5, we dropped the full 50% long, which comes around 632. Also, 630 and 3/4 actually. So we'll keep an eye on corn here for where support could hold on pullbacks. I am a little worried that we're getting exhausted into the levels we're at. And we kind of are due now for, I think, a pullback to some extent, whether it's 20 cents back into support, which could be a long, for continuation higher, or if it's much deeper than that, that remains to be seen. But I'm sure the market gods will reveal all in good time to us. I guess actually while we're on corn, let's take a look at that before I actually do move into soybeans here, and we wrap this kind of quick video here today. The strategy of the day videos are going to be a lot shorter, maybe 1 or 2 topics, just a chart or two of the 2 big movers for the day, or talk about something that's that we need to. But anyway, looking at an intra-marketing year spread here, the corn, this is the December 22 corn spread against the December 23, July 23 corn. So this is the current new crop to the end of the marketing year, July, the last of that new crop, which would at that point be old crop, that we have on the books. This spread is a carry trade spread. We anticipate this type of spread potentially trading to full carry in the type of year where we have good production and a carry out that doesn't warrant inverted market conditions. And this market is flirting with that idea. Going out to a daily chart real quick, you can see that the range that this spread has traded is rather tame. It's only been as wide as 30 cents high and as narrow as 15 cents under. I guess 18.5 cents under there back in August of 2020. But really, we're more concerned about this more liquid time for the spread after December of 2021, where we've really been in a range between 13 cents under, got as high as 30 cents over there at the earlier mid-year. You notice the spread barely could make it to 10 cents over there during the peak inverted conditions we saw this during the summer time months. That would have been the most bullish that corn had been, and yet the spread was already being bear spread. And yet here we are here today trading up to 5 cents over. Can't really get over that area. And I believe this chart's more or less in a range between 13 cents under and 5 cents over now. So I think there's an opportunity here to be bear spreading this December 22, July 23 corn, and looking for a move that could take us just conservatively back down to 10 cents under to 15 cents under. So, the risk on bear spreading this at even money, I guess, is where we went out today. I was doing this earlier today at 2 cents over and better. Risking 5 cents, 5 to 10 cents seems to keep a stop pretty far out of the way, and certainly risk the reward for 10 cents at least lower. And then if we do find ourselves in the type of carryout year or next year where demand either doesn't come in and cause inversions, or supply does surprise a little bit more to the upside here, which let's just talk about the WASDE for a quick second. Kind of shocked to see them not acknowledge as much of the corn problem that we've seen both DTN and ProFarmer come out with much lower yield numbers than the 172.5 that the USDA released in their September WASDE report. But that soybean number was the real shocker to the market. Obviously, we all saw what it did to market price action. 80 cents off of its lows from yesterday in the soybeans, testing above $15, but now back below. We'll look here in a minute and see if that's sustainable for the soybeans. But only surprising us with a cut down to 50.5 bushels an acre there on the yield for the soybeans was kind of an out of character move for the USDA in this report, and certainly doesn't acknowledge what the other two current yield estimates are kind of suggesting, which is actually maybe the soybean crop's doing a little bit better than we are expecting, and certainly that could be the case. I'm not here to judge that. Just here to tell you where everything is. But here, looking at our December, I've got a cost of carry chart up in front of us, or pyramid, or grid, whatever you want to call it. It tells us where basically the thresholds of these spreads that can trade between are. And the number that I look towards here and I'm looking for on this one is we're dealing with the December 22 corn to July 23 corn spread. So this is these are the numbers that we're concerned with here. The cost of carry of that spread is 73 cents. We're currently at minus 1% of full carry. We'll get to what that means in a minute. See how many of these are minus hundreds? That means they can trade a long way back to full carry. Any number that's green, the closer it gets to 100%, the closer to the floor in these spread charts we're getting. The market carry is currently 5.5 cents under, or was over, and this hasn't really updated yet, but more of the story here is that this December 22 corn to July 23 corn, 73 cents is our cost of carry. That means that on our spread chart, this market could, in theory, if it's going to be a carry building type of year into next year, and I'm not saying we're going to trade down there on this spread, but maybe the March to July spread has a better ability to trade towards full carry. But full carry would be all the way down here at 70 cents under. 80% of that would be at 60 cents under. So if we started being bear spread, this market could fall fast and head down to those levels. Not saying this is the type of year it would happen, but I think a retest down towards the low end and the contract lows of this chart is probably what is in order if the market's going to want to build some carry in the near term. So hopefully that logic played out for everybody. There's a lot to chew and swallow there, I know. But let's get into soybeans now. Taking a look at the November 22 soybean chart, new crop beans here finished down 9.5 cents on the day after being above $15 at one point. A little disappointing, I would say, for soybeans to have fallen apart the way they have off of trading above $15. Seems to me it's one more rejection up here at this kind of high end of the range that we've been in, and it might be a little bit of a panic sell-off type of top to the market in the near term. Coming off of overbought conditions that peaked around 1.0 there yesterday, and certainly have battered back down to about 0.90. We'll continue to monitor that here as seem to maybe be rolling over already. 18-day moving average is still way below us at 14.28. 100-day moving average at 14.51. 55-day down at 14.03, and that 200-day down at 14.14. All of them below us. So reversion to the mean at this point, I hate to say it, but it's for a pullback and could potentially give us one in this environment because of just the volatility we're seeing. We're seeing some risk off here. If that trickles into the beans, well, we could come down just as fast or faster than we went up, and that's often scary. And this is the time of year that we see that type of price action. I wouldn't be doing my job, risk manager and trading market strategist, without pointing that out. All right, so on that corn chart, we looked at that broken 61.8 line that I had turned purple. Well, there's a reason I did so, or magenta, whatever you want to call it. On this soybean chart, we've been inside of a very similar range here for the last several months. We broke 61.8 lines on that rally. We then fell back and we failed to hold the 50% and broke the 61.8 lines. And then we basically traded in a range for a month and a half sideways that we identified. We were ready for it. We let it happen. The market has now traded above two trendline resistances that kind of had an apex or right around this 1480 area. We're pulling back to trade them and hold it as support. So, okay, it's a bull market doing what bull markets do. The problem is that we're falling back into the old range for the month of June here, or excuse me, the month of August, where September was starting to push above, right? We're starting to break above this area, this high from July and August, and now we're breaking back down below. If selling pressure overnight takes us back down, there's not many levels that I would risk being a buyer on a dip now, because we're kind of falling back into a range where this range has been very volatile and it has taken the stairs down at times, when it wants to. And if it wants to, this is the time of year it does. So being very cautious, I'm cautiously optimistic. It was still a green, good close for, the week's price action so far. But you know, it's all coming off of a new spike rally from yesterday, and if that decides to fade away here, it could get ugly very fast. And we do have an open gap below us down at 13.49, an open gap above us at 15.34, and I mean, we're not that far off from no man's land right between them at 14.40. So just, you know, one of those things with beans is be cautious, be optimistic, but be aware that this market is very quick right now, and you run the risk of, in my opinion, of soybeans really moving big in both directions here. But with great risk comes great reward. But futures can work for, you know, the leverage of futures works for you and against you. And this is one of those situations where that very big volatility could lead to, you know, bigger increases in margin requirements and all that kind of stuff too. So anyway, we'll cover more on the soybean trade and if the trend is continuing here in Thursday's webinar. So do join me there on Thursday at 2 p.m. Central for the Strategy of the Week webinar. Sign up links are available in the comment section and information section of this video. And until then, everybody, thanks for joining me for this Strategy Day recap of corn and soybeans. I'm Dan Hussey from Zaner Ag Hedge. Can be reached over here at 312-277-0110. Find me on Twitter or Facebook. Shoot me an email here at dhussey@zaner.com. Leave your likes and your comments of the video below. Have a great day, everybody, and we'll be back with you as price action develops. Take care, everyone.